Ever wondered why most traders lose money? It's not a lack of knowledge or some secret indicator they're missing. It's the absence of a clear, structured decision-making process. Professional traders don't start their day by asking, should I buy or sell? They start by reading the market's flow. Today, I'm going to show you exactly how they do it, using a powerful 3-step framework that will completely change how you see the charts. Let's get one thing straight. The market doesn't care about your indicators, your predictions, or your hopes. It responds to 3 things: structure, liquidity, and collective behavior. Real consistency in trading isn't found in a shortcut or a magic setup. It comes from having the right mental framework that guides every single decision you make. This 3-step process isn't a get-rich-quick strategy. Think of it as a compass for navigating the market as it truly is, not as you wish it would be. By the end of this video, you won't just be looking at charts. You'll be reading the story they tell. Let's dive into step 1, reading market flow. The goal here isn't to get lost analyzing every single candle. It's to understand the bigger picture. We're not asking, what is the market doing right now? But rather, what is the market trying to achieve? This is a fundamental shift in perspective. Most retail traders get caught up in short-term noise, mistaking every little bounce for a new trend. But a real trend is defined by its underlying structure, not by temporary reactions driven by weak emotional traders. Markets are in a constant dance between 2 states, balance and imbalance. Balance is when buyers and sellers are in agreement on price. The market moves sideways, coiling up energy. Imbalance is when one side takes control, revealing directional intent and pushing price with force. Professional traders are masters at identifying who is in control and how that control is being expressed. They look beneath the surface noise and focus on sustained, powerful movement. Before even thinking about a trade, an experienced trader performs a quick mental checklist. Is the market direction clear? Is the structure well-defined? Is there momentum behind the move? Just by asking these 3 questions, you can filter out the vast majority of low-quality, high-risk trades. Reading market flow doesn't magically print money. Its primary job is to keep you out of traps. It's your first line of defense against making impulsive, costly mistakes. You stop reacting and start anticipating. So once you understand the flow, where do the profits come from? That brings us to step 2, identifying the deviation. High probability trades, the ones that can make your week or even your month, don't happen when the market is behaving normally. They occur in moments when the market briefly deviates from its expected path. This is where the magic happens. One single, well-executed trade on a clear deviation can be worth more than dozens of random scalp-style trades. So what is a deviation? It's a moment when the market structure temporarily breaks and liquidity is exposed. These are the moments when large institutions, the smart money, reveal their true intentions. While everyone else is getting shaken out, the pros are getting in. They wait patiently while the market is in balance, conserving their capital and mental energy. Then, when a clear deviation appears, they act with precision and decisiveness. Common signals of deviation include things like liquidity grabs, where price spikes above a high or below a low to hunt stop losses, only to reverse sharply. You might see breaker zones, fair value gaps, or volume climaxes, but listen carefully. These are not just patterns to be blindly chased. They are conditions to be recognized within the broader context of market flow. A true deviation needs confirmation. You need to see a strong price rejection, clear shift in control from buyers to sellers, or vice versa. And you need to see the microstructure, the smaller time frame trend, begin to fail and reverse. Without these confirming elements, what looks like a perfect setup is likely just another trap. Patience is key. You wait for the market to show its hand, confirming the deviation before you commit a single dollar. Now for the most important part of the entire framework, the step that separates the amateurs from the professionals for good. Step 3, your risk protocol. Let me be blunt. Trading is not a game of prediction. It's a game of survival and discipline. You will be wrong. I am wrong. The best traders in the world are wrong. But a skilled trader might be wrong and lose a little, while a disciplined trader stays in the game forever. Risk management isn't an afterthought or an optional add-on. It is the absolute foundation upon which all trading skill is built. It's what allows your winning edges to compound over time. A good trade is not defined by whether it made money. Good trade is defined by how well you followed your process. Did you stick to your plan? That's the only question that matters. This means having strict, non-negotiable rules for everything. Your emotional state, the market conditions you'll trade in, your minimum probability threshold for taking a setup, your position size, and your exit plan. Your stop loss is decided before you enter the trade, not after. When emotions are running high, consistency isn't about winning every trade. It's about executing the same proven rules day in and day out under all conditions. This is why journaling is non-negotiable. It's not just about tracking profits and losses. It's about tracking your behavior. It helps you identify your personal patterns, your emotional triggers, and your recurring mistakes so you can systematically correct them. This is how you build a fortress around your capital. So, how does this all come together? Let's integrate the 3 steps. Market flow defines your direction. It tells you which way the river is flowing, so you're not trying to swim upstream. Deviation defines your timing. It's the specific, high-probability moment you choose to enter the water. And your risk protocol defines your survival. It's your life jacket, ensuring that even if you're wrong, you live to trade another day. When these 3 elements align, trading transforms from a chaotic, emotional gamble into a structured, logical business. Your decisions become clear, objective, and process-driven. You stop chasing price and start letting the best opportunities come to you.
Yes.
True, lasting success in this game doesn't come from finding more indicators or building more complex systems. It comes from applying a simple, robust framework with unwavering discipline and patience. Those who take the time to master this approach gain a permanent edge, not through luck or secret signals, but through clarity, control, and a deep understanding of how the market truly operates. This is the path. It requires work, it requires focus, but it's the only path to consistent profitability. Thanks so much for watching. If this framework resonated with you, hit that like button and subscribe for more deep dives into professional trading. Let me know in the comments which of these 3 steps you're going to focus on first. See you in the next video.